Let's now consider how we would draw this answer into time paths. So the case we considered was a case of domestic pessimism. I was unclear whether it was consumption or investor pessimism. It could have been both. It could have been a drop in consumption and investment. But one way or another, aggregate demand falls due to a fall in one of those two. So the short run response is these things decline due to the pessimism. That generates a drop in aggregate demand. So the economy starts in equilibrium right here. This is where we started. And when you were in equilibrium there, you were at this price level, you were at full employment, and you were at the natural rate of unemployment. So the economy, if nothing had happened, would have just continued to purr along in equilibrium. And if you were looking every morning at the price level data, it would be the same every day. If you looked at output level, it would be the same every day. Unemployment would be steady. So you were sitting in equilibrium. All of a sudden, people become more pessimistic and aggregate demand drops. When aggregate demand drops, now we have this movement here, and we've now moved down to this price level. Okay, so I'll use green for that. So you're here, this price level. So this is your short run where you're at. That's reflected in our notes as a drop in the price level from P0 to P1, a drop in output from Y0 from full employment output down to Y prime or Y1, and a drop in output is associated with an increase in unemployment. So we're going to fall down to here, output is going to decline down to here, and unemployment is going to go up to here. So this is when the shock hit, and we see the price level decline to here. We see unemployment, or employment decline to here, and unemployment rise up to there. Now, let's use blue for our long run. In the long run, the economy learns that it's now at a lower price level. People build that into their expectations. Softer input prices at companies allow them to increase output and production because costs have essentially declined, and that all leads to an increase in the short run aggregate supply curve. So the long run adjustment is for that to increase, which brings us down to here, back to our full employment level, back to here. So what happens graphically? Well, the price level fell. It fell in the short run and it fell in the long run. So the price level fell all the way down to here. So it continues out there. Output has now recovered back to its full employment level. And unemployment has fallen back to its natural rate. So all three time paths are pretty clear. Prices we would expect to see falling the whole time. Output would decline and return. Unemployment would rise and then fall back, the opposite of what output does. One last note. When you use this analysis and you look at the time paths, the value is in these things. It allows you to look at data and see what happened and then come back. And I'll give you an example. If you see a decline in the price level and a drop in output and a rise in output, you know that the shock was an aggregate demand shock. It fell and fell, output declined and went back. If you saw a decline in the price level but an increase in output, it could have been this moving first and then that moving. So You can tell based on the time paths which curves moved in which direction, and that helps you interpret data. Last but not least, a simple aggregate demand aggregate supply diagram is very simple. It is an imaginary world where things are held constant. You look at the shock, and then you look and see where everything adjusts. When you apply it to the real world, you need to kind of look at it with one eye closed and say, what does this really predict? Does it predict output falls and returns and price level drops and then stays constant? No. What it really predicts is during an aggregate demand slowdown, we would expect to see a slowdown in GDP growth, probably not go from 0 to negative and back to 0, but you'd see the growth rate in the economy slow and then maybe return over time. Unemployment probably does go from its natural rate up and then back to its natural rate. But the price level, you probably have inflation in your economy going along at 2%, and we would expect during this recession that inflation slows down and then returns to its normal level. Those are the predictions you're actually making, and this is how you translate your notes into the time paths